Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Because they have credit controls, bubbles get created. Money comes in. It's kind of like the Roach Motel country. Money can come in, but it can't go out. It gets locked into the system because of the credit controls, and it has to go somewhere. It goes into overcapacity in industry in a big way, property bubbles, stock market bubbles. So that's how this overstimulus in China leads to bubbles, and we think there are big ones in a very big way. And think of it also, there's some external money coming in here, and you've read about the hedge funds trying to get more and more involved in here. They're trying to get involved as fast as they can in case there is some type of one-off investment, so you have more hot money pouring into China at the same time you have a bubble problem. So that exacerbates this in a very, very big way. So, U.S. double dip, the growth currencies get hit pretty hard. Aussie, Canadian dollar, New Zealand, Brazilian real, all of them we think get whacked in the U.S. double dip because U.S. double dip we think feeds back into this problem right here and ultimately could lead to a break in the credit bubble. If the U.S. double dip leads to a break in the Chinese credit bubble, these things don't get hit hard just on a short or intermediate term basis. These commodity currencies get destroyed. And, you know, when you looked at the Australian dollar and saw what it did during the credit crunch, it went from close to par and just got crushed like 30-40% in a month or two, a couple months, I guess it was over a month. That's what I mean by destroyed. So if these scenarios start to develop, you want to be short the growth currencies in the world, the commodity currencies that are predicated on China keeping the music playing, predicated on the U.S. growth continuing. So that's the first block. If this happens independently and U.S. growth stays somewhat on track, China stays somewhat on track, and we see just the European Monetary Union break up, obviously you want to get short all of the European currencies. Euro first, Swedish krona second. Again, on a relative basis, the Swedish krona should perform better than the euro, but Swedish banks have massive exposure to the Eastern and Central European countries. And as I said, the pressure on them is already great. If we see a contagion from Greece, it's going to hit those countries very hard, and it's going to roll right into the Swedish banks. We've seen this. We've already seen hints of this in the past during this post-credit crunch cycle of the Swedish banks getting hit and then rolling into the currency short term. So that's one to be short. The British pound ultimately too. Again, the pound is not part of the European Monetary Union. They're part of the Eurozone. The pound has its own problems we didn't get into. It's a whole other scenario relative to British finance. You're going to see money probably move if we get a European Monetary Union breakup. Obviously, money move from Europe into the pound is a bit of a hiding place, but the U.S. bond market will be the major hiding place if we get that or continued threats of this. So the commodity currencies first on these two scenarios. The European Monetary Union obviously speaks for itself. Just some charts here. This is a chart we have on the U.S. dollar. What we saw really, we think, is this labeled 1 here, this move off of the bottom. We think is really just, you know, phase 1 of this move. The correction that we saw, maybe we've already made a wave 2 correction, looking at this as 1, 2, 3, 4, 5 in a big way. Ultimately, the target we have on a multi-year dollar bull market move is up around 125, 120 to 125 on the U.S. dollar index. Right now, it's at 82.50, as you can see. So. On a long-term basis, we're expecting a very, very big move in the U.S. dollar. And here's where we are, as I said, on a daily basis. Whether or not this correction is done in here, what we've seen already, the pullback in the dollar, we don't know. We'll just have to watch and see how this plays out. No doubt if the stock market breaks, we think the U.S. dollar is going to get another risk bid up. And that's the near-term thing that we're watching. This is the euro on a weekly basis. This is again a wave chart on the euro. Euro made it to 160 here, all-time high against the U.S. dollar. Credit crunch crush all the way down to 123. Big volatility all the way back up, and now we've started down again as people recognize the problem in the European Monetary Union. What's interesting is the change in correlations. If you think about this, stock market's been going up, 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 up. And guess what else has been going back? Up, 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 the U.S. dollar. In the past cycle, the U.S. dollar went straight down, almost tick for tick as the S&P went up. That has changed. So something has changed in the world in a big way, and that's part of our story. As the U.S. stock market continues up, it's going to pull in capital globally and support the dollar at the same time. Again, very much like the 92-2002 bull market in the U.S. dollar. And this is just a chart. There's a lot of lines on here, but hopefully you can see them marked. The red is Australian dollar, Canadian dollar blue, Brazilian real. This is the S&P green, and this is Chinese stocks. This is Shanghai Stock Market Index, the black line. And what I want to show you is just how tightly these are all correlated. All crushed during the credit crunch. All took off in March 2009 in the midst of green shoots, if you remember. Boom, 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 boom. But what's interesting, in the Australian dollar from a major commodity currency is really the key risk currency in the world. Risk meaning as this started to move back, it's moved up the most. And everybody is very, very happy about the Australian dollar. Minutes of the Reserve Bank of Australia meeting came out last night. Very aggressive. It didn't surprise us. We expected that. We think a lot of the good stuff is in the Australian dollar. So if we see any break in terms of those scenarios, this is why we say the commodity currencies, we expect them to tank along with any real risk event. And you're seeing the Chinese stock market, as I said, start to turn over a little here, so watch that. The Chinese stock market hasn't been as directly correlated to these currencies really as the S&P has, but things are changing. The S&P was fairly tightly correlated with China, and we're starting to see a relative divergence here. Let me move get some of this off here again, sorry. If we just look at these two price series, and again, this is a little tough to do here. These are weekly charts, by the way. Let me grab my pen again. Here's Chinese stocks. Here's the S&P right here. So we're starting to see a little divergence here. But you can see the Australian dollar, everybody loves it. If China gets in trouble, this is the one to get hammered again. Look how far and how fast the Australian dollar fell here during the credit crunch. It was up in here. We were approaching par against the U.S. dollar, and of course everybody thought par was inevitable. And the Australian dollar just went down along with the rest of the commodity currencies, but on a relative standpoint, because it's the key risk ebb and flow of the major currencies, it got hit the hardest. So that's why we say that's the one we want on our list if things start to break and go south. And there's some additional information on us. We have a free currency you can get every morning. These are our paid services. Currency Investors monthly. This is kind of intermediate term position trading. This is a very short term trading. Send us any questions at info@Black Swan Trading if you have questions on these services or anything I prepared here. And I'll try and get to your questions right now. And if you have questions, go ahead and type them in. And we don't have too much time. I think I already went over, but we can spend a few minutes on the question. I apologize.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.